If you have a stock portfolio, a 401k, or really anything denominated in US dollars, what I'm about to show you has cost people everything repeatedly throughout history. And it's happening again. The Roman Empire, 260 AD, the currency died. The British Empire's currency died in the 1940s. The German Weimar Republic's currency died in 1923. The Soviet Union's currency died in 1991. Different cultures, different centuries, different reasons, but the same ending. And right now, for the first time in history, the US government is paying more to service its debt than it spends on the entire military. Just let that sink in. And by the end of this video, that's my goal, is you'll understand exactly why currencies fail, how often it's happened, and most importantly, the framework I use to position my portfolio so that whether I'm right or wrong about the timing, I come out. Okay, this isn't doom and gloom. This is pattern recognition. So I'm going to show you a pattern that's repeated for 2,000 years, and I explain how I'm positioning my own money because of it. So let's start with Rome. Why? Because it is the perfect case study. In 64 AD, Emperor Nero, that lunatic, had a problem. He just had a massive fire destroy most of Rome. Some people rumor that he started it, and he had very expensive wars to fund. And like every politician since, he really enjoyed spending money that he didn't have. Right now, Nero couldn't exactly fire up a printing press, but he could do the next best thing. He could debase the currency, the Roman silver coin. So they had this coin, and there was a picture of, a chap that's meant to be Nero. And this silver coin was meant to be, guess what? Silver. Almost pure silver. It was about 95% silver. Maybe they had to put some other things into it to make it easier or something, I don't know. So what did Nero do? He said 95%. Let's bring it to 90%. No one's going to notice. And guess what? His successors were inspired by this lunatic. And by the time you get to move forward a little bit, about 200 years later, let's call it 260 AD, the silver in the coin was no longer 90%. No, they'd lowered it and lowered it and lowered it and lowered it and lowered it, and it was then 5%. Some of the old coins we're digging out still have 2% silver. It was basically a copper coin with a very thin silver wash sort of sprayed on top. And what happened? Hyperinflation, loss of trust, economic collapse. Soldiers demanded payment in goods instead of coins because the coins were worthless. Guess what? The empire fractured. Now, if you asked any of these emperors around that Roman times, and what's the value of the silver coin we have, the denarius, they would have said to you it's worth exactly the same. It's this silver coin is a silver coin. It's worth what it's always been worth. So, sound a little familiar? So the official story is everybody is fine, right? Your money is just as good as it always has. But the reality is your money buys less. But let's go back to the US and the dollar, because that's where most of us put most of our money. Have you noticed prices are rising faster than your paycheck? Your parents bought a house for what now seems like pocket change. Your savings account earns, 4% if you're lucky. But real prices seem to be climbing at 7, 8, or 10% a year. And things are starting to feel expensive. But no one's calling the crisis. The Fed calls it transitory inflation, trending towards our 2% target, which basically means we're printing money, you're getting poorer, but please don't panic because we have a plan. Well, sort of. Maybe we'll be data dependent. So things look stable on the surface, right? You got good GDP numbers, job reports are okay, but something feels off. And that disconnect you're feeling, it's not irrational, it is historically consistent. My name is Felix Pin. I'm an ex-investment banker. That's Winston back there who stand all the hard work and research here. And we're also the founder of the GOAT Academy, where my retired Wall Street mentors, the guys I look up to, guys who actually build institutional trading desks, they teach their regular investors like you and me. The strategies are usually reserved for, the hedge funds, the family officers. And for the last 6 years, we've taught over 20,000 students. I'm also the co-founder of TradeMission.io, where we keep up to date with what's actually going on in the world. And my mission is very simple. I want to give regular investors access to the knowledge and the tools that Wall Street keeps, locked behind closed doors because the wealthy are not worried about what I'm about to tell you. They already know. They're already positioned. The question is, are you? Everybody says, oh, every currency dies. Let's be specific about what we mean by that. Because most people hear that and then imagine the sort of, Mad Max scenario where dollar bills are literally worthless and we're all beering with canned goods and, bones. That's not usually how it actually works. So, currencies don't disappear. They degrade slowly, quietly, over years or even decades. You still get paid, you still go to work, you still buy groceries. The money still works, but there's a catch. It buys less. Since 1913, which is the year the Fed was created by, I was going to say JP Morgan, the banks. Let's leave it at that. The US dollar has lost how much value? What do you think? Put a comment down below in the chat. 1, 2, 3. It has lost 96% of its purchasing power, which is a really fancy economist word for value. 96%, not a conspiracy theory. That is the Bureau of Labor Statistics data, the government's own data. You can go look it up yourself. What cost your grandparents $1 now costs you $30. That's not normal inflation. That is currency degradation. You're not that special. This isn't unique. This isn't new. It certainly isn't unprecedented because while everybody throws that around in sort of mainstream media, if they ever get to this topic, this pattern has played out again, over and over and over. The people living through it thought their currency was different, their government was smarter, the situation was special. It never was. There's a really good rule one of my mentors taught me. They said when people say this time is different, tell them it's not. Talk to our friends in Great Britain, which is now just Britain, and they have a currency that used to look like this. It is the pound sterling. It was the currency of currencies. It was a currency that was insanely valuable. When Brits went abroad, they thought they were visiting third world countries. Everything was cheap. Now talk to Brits now because what's happened in the UK is that the pound has lost an incredible amount of value compared to other currencies. It doesn't give you entry into everywhere for very little anymore. What's happened is that salaries are basically flat for 20 years. Now I used to live in the UK. I got a first job as a lawyer and I got paid first paycheck was £28,000 a year. Seemed like a lot of money back then. It wasn't. But right now if you start off as a lawyer you get paid almost exactly the same thing 20 years later. Living costs have exploded and gone up dramatically. What it means is that the value of the pound's gone down, but also the value of salaries has gone down. And then on top of that, most Brits put their money into the UK stock market, which is something called the FTSE, which has also massively underperformed the US markets. Had a little bit of a boom because there's a war going on in Europe and wars are very profitable. But other than that, it's been a bit of a freaking disaster. So they've seen their pensions, which are tied to their stock market, go up 2% a year, go to the US for the same time period. And they would have gone up about 13% a year. And that makes a huge freaking difference if you do that for 10 years, right? One is like, dirt poor mouse, and the other is the loud, brash American friend. This did not happen suddenly. This kicked off really in the 1940s, when I was going to say, the US decided that Britain's empire was over, which is pretty much, I think, the true story. But the empire crumbled. So it wasn't a sudden apocalypse. It was a slow erosion. Most people don't notice it. Most people still don't notice it. Talk to the average Brits. I'm sure there'll be a few outraged chaps in the comments down below. I'm German. The Weimar Republic. That one's quite famous, right? Workers were paid twice a day because money lost value so fast. People used wheelbarrows of cash to buy bread. The currency was replaced at a rate of 1 trillion old marks to 1 new mark. The other way around, you get the idea. Talk to our Russian friends. Are we still allowed to have Russian friends? The ruble collapsed in 1991 because Yellen's vodka bill made the country bankrupt. That's the unofficial story. But basically the ruble collapsed pretty much overnight, and lifetime savings became worthless. So people who worked their entire lives found the retirement accounts. Well, it wouldn't buy a loaf of bread. The entire thing. So, different reasons, different technologies, different political systems, different centuries. But the pattern's the same. Government takes control of money. Government spends more than it collects to be popular and possibly fill coffers of people they're friends with. And then government prints money. Why do they print money? To cover the gap. So the currency loses value. And people who saw it coming, they held real assets. They survive. People who didn't, well, they didn't. So why does this keep happening? Why hasn't any government in history been able to resist this temptation? Because the incentives are all wrong. Think about it. Think of it from a politician's perspective, right? So you are a politician. You have two options. You can be responsible, right? So what do? Well, you cut spending, you increase taxes, and you lose the election, right? Your opponent who promises everything. Well, they win. Your second option is what? You just fund everything. Free stuff for everybody and checks and bailout money and dividends and just hand the money out. And the consequences are going to be the other down the road. So, by the time the bill comes due, you're either retired or you're dead. But you were kind of popular. Do you choose popular or do you choose unemployed? Those are the two options politicians have. Problems are, once you start with the popular thing and just handing up money you don't have, and the US government has, $39 trillion in debt to service that debt, just to pay the interest, not to pay it down. The government spends well over $1 trillion, which is more than they spend on the entire military in the same period. And so, how do they pay it? This is the insane part. New, freshly minted debt pays the interest on the debt, which means the interest creates more debt, and the debt creates more interest. So what's the only politically acceptable way out of this little circle? Well, you can't default because that will just end the party. You can't raise taxes enough. The numbers are too big. You can't cut spending enough. The position survives. By the way, somebody read in my comments the other day, "Oh, no, you could just tax all the billionaires at 100% of income. You would collect, 15 trillion now and then another 20 trillion over the next 10 years. That chap was an economist. He says the problem is once you raise taxes above a certain point, the billionaires leave. They take their money and their companies with them. And it might seem incredibly fair that they have billions and you don't. But that's the reality, right? Look at the UK. They raised taxes. What happened? They're collecting less money. Why? Because all the billionaires moved to, Monaco or Dubai or Italy or Portugal or somewhere where there's lower tax, right? So it's not really a viable option. And if you tax the masses, more people, well, everyone, can hate the billionaires, not that many of them. But you start taxing everybody, well, you get voted out of office. And if you want to move beyond the headlines into actually understanding how Wall Street positions themselves, whether the market goes up or down or around and around she goes, I've actually recorded a mini video for you. It's only 17 minutes long where I break down that whole system. You can watch that little mini masterclass on how to buy more and sell more like the Wall Street guys at phoenix.getfree. There's a link in the description. You can check that out at the end of this video or right now if you wish. The printing press is a beautiful thing. You print money. What happens when you print money? You have more dollars. Therefore, the dollar is worth less. Debt is also held in dollars. So your money is worth less. So your debt is worth less. Not a sort of very obvious concept, but that's what happens if you are an American and you hold some cash or you have a salary that pays in cash, which most of you do. Guess what? You're paying for the printing, but it's quiet. It's silent. There is no tax bill, it just sort of happens. It's a slow and steady erosion of everything that you've saved. And I'm sure there are some objections. Let me know if you're one of those who say, "But Felix, America is different. We have the world reserve currency. We have the biggest military. We have the biggest economy. We have all the economic, technological advancements and innovation and the smartest people and the, more golden retrievers than anybody other country." That kind of thing. And then that might all well be true. But I'd ask you, was Rome not the most powerful empire of its age? Was Britain, formerly Great Britain, now just Britain, not the greatest empire of its age? They ruled 15th of the world. They had the world's reserve currency before the United States. So having the world's reserve currency does not prevent currency degradation. It delays it, buys you time, but it doesn't buy permanence. The average lifespan of a reserve currency is 94 years based on historic data. The US dollar has held reserve status for now. How many years? Anybody? 100 plus. That doesn't mean it collapses tomorrow, but it does mean we are in uncharted territory. We're past the average expiration date. It's like that yogurt you're looking at going, "It's a week past its expiration date, but I still really want this chocolate yogurt." To understand why we are here, we need to understand what the central banks are doing, Because they are not acting like everybody is fine, right? Most people are just like, if I tell people this, like, are you not worried about the loss of the reserve currency status and inflation? And they just look at me and they go, lunatic, right? But central banks, they bought 863 tons of gold last year. That is the third year in a row of buying over 800 tons of gold. They got the Poles, the Kazakhs, the Brazilians, the Turks, the Chinese. They're all accumulating gold at the fastest pace in 50 years. Why? Because they've read my script. No, they understand what's happening here. They are diversifying out of the dollar. They're preparing for a world where the dollar is no longer the sole king. Why do I care about that? Because the central bankers are the same lunatics that print the money, right? And they're hedging their bets with gold, not their own currency or any other financial instrument denominated in their currency. Where are we with this reset? What are the signals? What should you watch out for? You might want to write this down. What are the signs that we're further along in the cycle than people might realize? Well, the signs are already here. You just have to actually know where to look. Let me give you a couple. Write these down. Signal number 1 is central banks, not ordinary banks. Central banks are changing their behavior. We just talked about that, right? They're buying gold. They're doing it quietly. Backdoor stuff, right? Signal number 2, interest payments exceeding all the key items in the government budget. So, exceeding the military budget in the US. That's kind of a red flag, right? So, it means that debt is starting to compound faster than the economy can actually handle. We crossed that threshold in 2024. As I'm recording this, we're 2 years into it. The signal number 3 that I look for is the economy. Watch how politicians and central bankers talk about the economy. Notice how many things sort of require these strong GDP growth. It's mostly healthcare inflation, by the way, and government spending. Low unemployment, which doesn't count the people who stopped looking. Healthy consumers, well, they're paying their groceries with credit cards and buy now, pay later, right? They're ordering their Uber Eats delivery with buy now, pay later. And you kind of look at those things and you think, well, those things are not healthy. They are things we should put in speech marks, right? And then the fourth thing, and maybe that's the best place to start, look at what the wealthy individuals and institutions are actually doing or what they're saying. Follow the money. That's always my key mantra as an investor. What I learned from my mentors is like, follow the money. Everything else is just opinion and politics and noise. What do they own? What do the wealthy own? Well, they're putting it into things like real estate, right? Buying up all the farmland and all the burned down bits of California, right? They own businesses that have the ability to hike prices. They own commodities, gold. They own productive assets that go up with inflation. Now, before somebody throws in the comments, but Warren Buffett has all his money in cash. No, he doesn't. He does it in bonds. He just calls it cash because they're cash equivalent, but they pay him an interest, an absurd amount of interest, which he obviously very well deserves for a life well spent. I want to talk for a minute about gold and silver, because these always come up in the conversations like this, and I want to be clear. I'm not a gold bug. Like, I'm not one of those guys who thinks we need to go back to the gold standard, or that holding gold is some sort of ideology. But I'm a pattern guy. I'm a follow the money guy, and the follow the money path is pretty clear. Every time we trust in paper currencies and those crusts get eroded, every time governments push the printing press too hard, gold and silver re-enter the conversation, right? It's been like the dead thing for boring people for decades, because they have one unique property that paper does not have. There is, write this down, there is no counterparty risk. What the heck does that mean? When you hold dollars, so cash, you're trusting the US government. The government is your counterparty. But when you're holding gold, you're trusting, well, physics. Gold is gold. It doesn't need anybody's promise to have value. Now, there is actually no inherent value in gold, which is of course true because it doesn't do anything. It doesn't produce anything. You have to put it in storage and pay insurance for it. But do you think gold is money? No. Enough people in the world believe that it's got value, including central banks. And again, if you look at what central banks are doing, buying gold. The World Gold Council found that 95% of central banks expect global gold reserves to increase this year. Nearly half said they're planning to add to their own reserves. It's not conspiracy theory. They're the people who run the system. They're hedgery. So for me, gold and silver are insurance, not speculation. I'm not trying to time the gold market. I'm not waiting for gold to moon. I hold some because history shows that in every currency crisis, the people who held real assets outside the system then better than those who did not. It's not ideology. It's not some gold push. I'm not sponsored. I get offered all the time. All these gold miners say, "Oh, you interview." I'm like, "No, why not? Because you want to pay me and I don't want your money." And maybe you're still thinking he's a bit of a lunatic. Dog's cute, but this guy's a bit mad, which is fair enough probably. But who loses in these situations? Problem with it is that it isn't obvious. It is quiet. If you're diligently saving your money in a saving account, you're losing purchasing power every single year. If you're earning 4 to 5% interest, real inflation, the stuff you actually buy is often higher. You're falling behind. If you are a retiree and you got your fixed income portfolio, you're living on a pension or Social Security, your checks might go up 3% a year. But if costs go up 6 or 8%, you're getting squeezed. Do that for 10 years. Do the maths. Your standard of living drops a little bit. You don't really notice it at first, but after a while, you do. And then there people are saying on the sideline, they say, "Oh, I'll invest when things calm down." Or, "I'm waiting for a better entry point." Every month, their wait is another month where their currency loses value. The cash is melting like an ice cube, right? This crisis does not hit all at once. There's no dramatic event. There are no headlines screaming currency failure. It happens so slowly and so quietly year after year that the people who lose most, they don't realize it's happening until they look back like 10, 20 years later and wonder why they can't afford what their parents could. But there is good news. This is not doom and gloom, right? Every currency crisis throughout history, well, it made some people wealthier, some people came out ahead. So, who are they and what do they do differently? There are people who own businesses that have pricing power. Say you are the only electricity company in your state. You're the only ones who make electricity. If you raised your prices, would people turn off the lights? No, they wouldn't. That would be a very simple example. There are other examples, right? Say you're Amazon and you have a cloud business right now. Say I run my entire business and you know hundreds of staff on Amazon's cloud business, lots of IT stuff up there. So if Amazon come out and go, "Look, your bill is going to go up by 10%. I'm going to go bastards and do nothing about it and pay it." Another example would be a petrol station. Say you have 2 petrol stations on different sides of the road. If one pulls their petrol up by 2 cents a liter, you're probably going to cross the road and go to the other guy.